Hey everybody, it's Ed and the future is now, and the future is the most powerful force in the universe. Compound interest. Okay, this isn't from the future. This isn't from me. This is Einstein. Okay? Who understands it, earns it. Who doesn't, pays for it. Think about it every time you're paying your credit cards. You're compounding interest for the banks. Okay, every time you're investing into stocks and making an annual rate of return, you are now earning it. So we want to be on the earning side. This is perhaps probably the most important video that I'll do when it comes to investing. Okay, and I made a spreadsheet, and as always, they're free. Okay, for everybody. So I wanted you to have it so you can use it, put your numbers in, what you're going to do with it, and you will see your rates of return and your growth in your investments and how they materialize over the next 10 to 20 years. Okay? So first thing I want to talk about basically is give you a breakdown of, the spreadsheet. Okay, I have the years on the left, column A. Column B is like the initial investment. Let's say you put an initial investment of $5,000 this year. You're new to investing, you put $5,000 in to the market, okay? And now you have an annual rate of return. Now 50% is high, okay? I put that in, okay, but I'm going to show you a bunch of different rates of return. You're going to put your actual rates of return every year in that column as you go. And you'll see your rate of increase, you'll see your year-end total, and then if you add any contributions on F, okay, so you'll see any contributions that you'll put in. I suggest that you put in contributions and you'll see why. Okay, so I put in 2,000 for example, which would be like $40 a week, and have it automatically go into your account, or you can add it all at once from a tax return or from some other source, So anyway, so on the right side, you can see the trading days. We have 250 trading days, but you don't have to be trading. You can be investing long term, short term, whatever. Okay, and then it shows your interest rate. You think, well, that 50%, that's high, right? And it is high. But if you think about it, and if you break it down per day, it's only 0.20% or 1% per week. 1% a week. Most people are trying to make these crazy 100%, 1x, 2x, 3x in like the matter of a month or something, okay? You only need to make 1% a week, even 0.5% a week, and you'll be making 25% annual rate of return. 1% a week times 50 weeks is 50%, okay? That's big. And if you make more than that, great. Think about a normal stock that moves 2 or 3% in a day. All you have to do is consistently make 1% per week. Average. You're going to have some bad moves and some good moves, but the key is to have a higher percentage of your good moves so you can hit that 1% or even more per week. Okay? But you can see if you add the contribution, this is based on adding contributions. You may not do that, and that would be the second set. Okay, but anyway, we'll get into the first set. So by 2031, if you put $5,000 in, you can make $1 million if you add 2,000 per year every year to your account, and you generate 50%. These numbers are accurate. You don't need to put in 20, 30, 50,000 into the market to become a millionaire investing. You need to have a constant annual rate of return that's solid. That is the key number. That's the number one thing you should be focused on. The annual rate of return and how to get there. Okay? Not trying to overdo it, not trying to constantly swing for the fences and constantly trying to make all these huge moves and making huge percentages. You just need to be solid with your percentages. Okay? And that's crazy. It shows you where it goes up. So you would start 2021 with 9,500, and you would start 2022 with 16,000, and you would start 2023 with 26. And you can see how that grows every year. Okay. Now let's say you don't add. Let's say you just want to put 5,000 in and not add any money to it. That's fine too. Okay. Now, what's the difference, right? What's the difference if you add 2,000 a year? Okay, is 1.1 million in 12 years, sorry. Now, if you don't add, it'll be $648,000. You think, wow, that's still a lot of money, which it is. But look at the difference. If you add a measly 24,000, let's total that, sum it. Okay? If you add 24,000 over the next 10 years, it would be a difference of 500,000 if you hit those annual rates of return. So that is huge. That's the power of compounding, and it's the power of contributions. You should always be contributing to your brokerage account instead of sitting making nothing. I'm not saying you need to have it in stocks every day, so I mean that's not the point. The point is you need to try to make your 1% a week, or a 0.5% a week, or up to 2% a week, or whatever. Okay, on average, you're going to have some good weeks. You can have weeks, or even 2 or 3 or 4 weeks where you're nothing. You're 100% cash potentially. Okay, that doesn't mean you can't hit those percentages. Okay, and that's what 0 yearly contributions would get you to that point. So if you think you need a lot of money to make money in the market, you have to plug it in your chart. You have to see these numbers are accurate. Okay, now this would be how much times your money you would have. 129x. Okay, 129x. That's crazy, right? That's the power of compounding. Okay, I want to make sure that's right. That seems even so ridiculously high to me, even looking at it. Okay, but that's the sum of E28, which is right here. I'm sorry, sum of E28 divided by B17, which is right here, divided by your initial investment. You put 5,000 in and you have 648,000. You just made 129x. Okay, so you don't need to make 3x, 5x, 10x on your trades. You don't need to do that to make money in the market. You need to consistently make 20 to 50% annual rate of return. Well, speaking of 20%, let's go down to 20%. Okay, that's a reasonable expectation for a newer investor. That's a solid expectation. I mean, that's what credit card companies charge. They charge 20 to 25% annual rate of return. They're pretty happy with that. That's cranking them in money. So you should be happy cranking that 20% in too. Well, if you put 5,000 in and you contribute 2,000 every year, you still would turn 5,000 into 121,000. So you can see that annual rate of return compounding is everything. I mean, if I end up making 50% a year, I'm turning in 5,000 into 1.1 million. Now, if you're doing only 20%, you're only turning into 121,000. So the key number that you should be focusing on, your goal shouldn't be money. Your goal should be the annual rate of return. Constantly making good trades and good investments in good companies. Okay, so you can see how that breaks down. And look at how much you would have to make per week on the trading days. Same thing. 250 trading days, 20% interest rate, 0.08% per day. It's not even a percent, 0.08%. It's not even 8%. 0.4% per week, not even 0.5% per week. Okay, you guys see the moves in companies, so you understand how much they move. It's crazy. They can move up to 20% in a day. Okay, all we're trying to do is hit these numbers, and you can see the growth from 5,000 to 121 with adding about 2,000. And you can adjust this any way you want. So let's say, hey, well, this year I'm going to add 10,000. Okay, I'm going to add 10,000 this year. Well, that makes a big difference. But you know what? In 2 years, I'm going to get X amount of money. I'm going to get another 5,000 in 2022. So I'm going to be able to put 5,000. And once you put these numbers in, you can tweak the chart. You can tweak the spreadsheet any way you want. Oh, I'm starting with 7,000. I'm not starting with 5,000. I've got 7,000. I'm starting this year. Well, that makes a big difference. Now you're 214,000. Okay, so all of these numbers are adjustable. Here's the numbers you want to be adding in. You want to basically put your initial investment in yellow, okay, and then your annual rate of return that your goal is. And every year you will plug the actual number into these charts, okay, so you can see really where it's going. And if these numbers are off, if you're like, wait a minute, my year-end total is not the same in my account, Well, it's probably because you took out some or you added some that you didn't remember you did, okay? So you always want to keep track of all your contributions. You want to always have a net gain on that. So if there's nothing wrong with taking money out. Oh, okay, I need to take 1,000 out to do XYZ. Okay, that's fine. Just try to replace that money. So try to be a net positive, okay? So, but anyway, just for sake, so you can see 5,000 investment, and that's 20%. That's 27x, 27x over 10 years, okay? If I said to almost any investor or even any investment firm, say, hey, I can make you 20%. Let's say I make you 20% a year every year, with X, whatever amount of money. They're going to be like, that's awesome. Absolutely, I'll take it. You want to hand it over to me now? Of course, they're going to take 5,000 to 137,000. Who wouldn't? Okay, so don't think 20% isn't a good number to try to hit. Okay, I'm personally shooting for about 50% myself, 1% a week. That's my goals. If I hit more than that, great. And we'll get into that a little bit later on the chart. And I'll show you, what I'm doing. Okay, but anyway, now 5,000 at 20% return without adding. Wow, that makes a difference, doesn't it? It's only 44,000. Wait, what? If I add all those contributions of 24,000, I get 137,000, but I'm only putting in a total of 29,000 to get 137. But if I don't contribute extra and I make the same percent, I only get 44. I mean, 8.99x versus 27x. Contributions matter. So you always want to be contributing to it as long as your rate of return is positive. I don't care if it's positive 1%. You want to add as much money to it that you can comfortably. You don't want to take food out of your kids' mouths or whatever, but in general, you want to add as much as you can if your positive rate of return. I mean, if you're losing money every year, I wouldn't suggest adding any money to it. I wouldn't suggest necessarily doing that because you're just giving that money away. Okay, so anyway. But I mean, if you're making any positive rate of return, you should be adding as much as you possibly can. Okay, so now we have, let me go down a little bit further. So you can see the difference with that, the 44,000. That's much smaller amount if you're not adding. Okay, and now with a 2,000 investment. A 2,000 investment, if you add 2,000 every year, you know what? I can add 2,000 every year. I'm just going to put my tax return. I get 2,000 every year back. I'm just going to put that tax return in this investment account every year. Okay, you'll have 94,000 in there at 20%. That's huge. That's 47x. That's massive. Okay, that's a great goal. Okay, now let's say you don't add. Well, you're only going to have about 17 or 18,000, but still that might be a reasonable goal for you. Say, you know what, I can't contribute every year. I don't have enough money to put in money every single year, so I'm just going to put this 2,000 that I can. You can still turn that into 18,000. You can still 9x your money. That would still be a solid rate of return. Okay, now let's get a little bit further. So you see the difference between 20% and 21%. Anyway, let me go up here. So that would be a huge difference, 51x versus 47x. Okay, now, I mean, every percent really matters. This is what I'm kind of, trying to get to. This is kind of the point, meaning every percent of that rate of return matters. So don't be loose and wild with your trades, because every percent makes a huge difference. Meaning 21% leads you at that 101,000. Well, what is 27? 94.9. I mean, you're talking about $7,000 difference from 1%. So every percent matters. So do your best on every investment and every trade. Don't just think automatically everything's going to work out. Always do your best. It doesn't mean you're always going to make the right decisions about things. Okay, everybody makes mistakes, so anyway, so 101,000. Okay, now $2,000 investment, you saw that it only gets you to about 19,000. Okay, and then let's say 5,000 investment, 30% rate of return. Okay, you can see the difference. 30 from 20 to 30. It's a massive, over $100,000 swing. 150,000 more by going from 20 to 30. Okay, these are big numbers. Okay, and it makes a difference. So every percent counts again. So 30% is usually, that's a good target. I think a lot of investors try to hit 30. Okay, 30 is a target. 20 is good, solid, but 30 is a good target to try to hit. I try to hit 50 with a minimum of 30. Okay, that's what I'm trying to do every year. If I hit 50, minimum of 30 every single year, I will be perfectly happy in 12 years. Okay, and I'll show you why. We'll get down to the future is now. Okay, so at 2020, with approximately 200,000, I'm at about 195. I've been moving money in and out, and I've got hammered in the last week Tesla issues, but not really with the Elon tweets or anything like that. It's more just, not kind of playing things properly. Anyway, at 200K with a rate of return of 50% per year, which would be 300,000 with a contribution of 2,000 a year. I've still put 2,000 a year down. You would see that 200,000 would be 26 million in 12 years if I hit 50% rate of return. That's why that would be a reasonable goal. Not even a reasonable goal. That's like a wild, awesome goal. That would be great to do. That's still 1% per week. Okay? 1%. 1% a week. That's not outrageous for me to hit 1% a week. Okay? And I'll show you why once we get down to the actual numbers. Now, I wanted to show you guys on the right side the rule of 72 really quick. Okay, the rule of 72 is basically you can divide whatever percentage you have, okay, by 72, and you'll get how many years it takes to double your money. Meaning, if you get 10% rate of return every year, it'll take you 7.2 years to double instead of 10 years to double. 10% times 10 would be 100%, right? That's compounding for you. And if you do 20%, it would be 3.6 years to double your money. So if you have $5,000, it will take you 3.6 years to double your money to $10,000. So it's another way to think about how long till I double what I have. Okay, so for example, if you look at the 200,000 to, let's say, 400,000, where's the 400,000? At 50%, obviously I'm going to double before even 2 years. Okay, 1.44 years. It'll get to 400,000. Okay, but that's at 50%. That's a massive number. Okay, these are usually the numbers you use for this rule of 72 would be 20, 25, and 30. So you can see at 2.4 years, you double your money. So those percentages really matter here. But that's the rule of 72 in case you want to be able to figure that out. Like, just kind of quick offhand, hey, well, if I got 10,000 in, it's going to take me, and I'm doing 25% a year, it's going to take me 2.88 years to double my money to 20,000. That's not too bad. Okay, so anyway, so this is definitely super lofty, and we'll see how it plays out. This is with adding, and this is with not adding. You can see that with not adding that $2,000, it's a $500,000 difference. $500,000 just by adding that 2,000 extra because of the magic of compounding. That is humongous long term at that 50% number. Okay, now I have the actual numbers for, I actually put in 2019 in the annual rate of return for 19. Granted, I basically was mid-year before I, was really, trading and, basically I wasn't really day trading a whole lot, mainly swing trading and long-term investing trading, besides just buy and hold type of stuff. Okay, but you can see the rate of increase was 31,000 for a total year end, and that was taken right off of my Schwab account, 128.04 at the beginning of 2020. And in 2020, we've already made 50%. I've already hit the goal. Okay, even through this pandemic. Okay, I already hit the goal, which is huge, but that was just because Tesla was on fire and we were pretty heavy in Tesla. And, so we made 64,000, and you can see the year to date 64,000 or 50.09 on the right side, and the 2 year change of 101, and 1 year change of 89 Okay, so anyway, so you can see the rate of, so basically in the first year, it's at 30%, which is solid. Second year is at 50. I mean, granted, the year's not up, and we still got, still got a few more months left to go. So we got May, June, July, August, September, October, November, December. We still have 8 months to go, basically. So we're not done with this. We're not done with this year. So I'm going to do my best to try to make another 10, 20, or 30%, maybe more. I'm just going to do my best to try to make as high a percentage as I possibly can. Okay. But bottom line, we've already hit our goal for this year. And I would like to make a little bit extra to make back for last year being a little bit short. But you can see the power of compounding, meaning we only, we basically got 100,000, but we only made 95,000. So is that right? So we basically, we're compounding at a rapid clip here. Okay. So we basically doubled our money, but we didn't make 100%. That's the power of compounding. You don't have to make 100% to compound your money. And it gets really big down the road. So, I mean, basically, if I can just keep the 50%, make sure that we don't lose money this year and keep generating money this year and continue to make 50%, the account should be somewhere around 20 million. And that seems ridiculous. When I even look at these numbers, I'm motivated, but I'm like baffled. I'm like, wow, is this really correct? And it is. These numbers are right, okay? And this is 1% per week. Oh, here, I put this on for contributions as well, because we plan on putting another 45,000 contributions to this general brokerage account before the year end. I'm not sure when that's going to play out, but so that'll definitely boost it up and give us a difference. Like, let's say I didn't put it in there, didn't decide to. 20.8 million. 16.9 million. Holy cow, that's massive. So, why wouldn't we? Okay, you're talking about making an extra 5 million potentially. So, we are going to add as much in contributions as possible. My company adds money to the contribution personally, just any way, shape, or form, tax returns. I told you, any way that you can make money, you want to be on the side of compounding, not on the side of paying debt down and paying interest to banks and credit cards. So that's the side you don't want to be on. We want to be on this side of the equation. This is why I said this is the most important thing for every single investor to do. And this is why I'm giving, I do it anyway, but all the spreadsheets, just email me to teslastock2021@gmail.com. That's my YouTube email. So email and say, hey, I want the compound interest spreadsheet, and I'll just ship it over. No big deal. Okay. You'll have that, and you can put your numbers in. Put whatever numbers that you have in there. So you can see it makes a big difference anyway. Always the two things I want you guys to get out of this. Okay. Well, three, I should say. Okay. The biggest thing, the three things, okay, compounding interest is huge and it works in your favor. So you always want your money compounding. Let's say you buy a home. Does your home compound interest? No, it may go up in value, but it's not compounding. Okay, the markets, and if you make that annual rate of return, that is compounding interest. Okay, if you buy a property and it goes up a couple thousand or 3,000, whatever, it's going up, but it's not compounding every year. Okay, you can compound your money in the market every year. That's number one, huge. Number two, annual rate of return is key. It's not about the money. It's not. It's about your annual rate of return. Okay, if you make a solid rate of return every year, your account will grow ridiculously. Okay, no matter how much you start with. If you start with 2,000, you start with 5,000, it will grow constantly. Okay, and the last thing is contribute as much as possible to your accounts, especially if you have a high rate of return. Okay, add as much as you can, within reason. And another reason to do that, it backs you up. If you have $10,000 sitting in there, it backs you up in case you get into an emergency situation. You have it there at your disposal. Okay? You can sell stocks and you can do something. If you're like, really, I wanted to go on a trip or whatever, you can sell some shares, sell $1,000, $2,000 worth, and go do these things. You can have it backing you up. It can finance a lot of things that you want to finance. Okay? So anyway, I'm going to wrap it up. I hope this helps you guys. And like I said, put whatever numbers you want. Doesn't matter. You put the number in, you put your rate of returns in, just like I did at the bottom, putting the rate of returns in. And every year I'm putting my final rates of returns in here, the account balances, and we'll see how this plays out in 12 years. I don't expect to do 12.8 million. I mean, if I will be perfectly happy with 20% a year for 12 years, I'd be perfectly happy with 1.8 million in the account hitting 20% a year. Okay? I will be perfectly happy with that. My minimum that I want to hit would be 30. That would be the minimum I want to hit. I'm pretty sure I can hit 20 in my sleep. Okay? But the minimum that I want to hit is 30. Why? That's 4.3 million. Okay, that's solid retirement money. I mean, it's not, total life-changing money, but it's solid. So I'm going to try for 30, I'm going to try for 50, but if I hit 30, I'm going to be I'm not going to be bent out of shape, going crazy, trying to leverage things and do crazy stuff, okay? I'm going to try to consistently hit those numbers, that 30% per year minimum, to get to that 4 million. But obviously, if you hit 50% per year, sorry, let me back that up, 50% per year, you can see the difference. It's a huge difference. So you want to do the best you can, and you will see that money grow. That is the power of compounding. Take care, guys. Be sure to subscribe, like, and send me an email if you want the compound interest spreadsheet. Take care.